Greetings everyone and welcome to the Argonaut monthly video. This month we're going to do something a little bit different and focus on political risk for investors globally, and particularly in the UK following the decision of Prime Minister Sunak to call an early general election. We're going to look at the outlook for the UK economy and the stock market under a new Labour government. So we're going to dispense with the usual format and cut to the chase. So for details of what happened in markets and the funds during the month of May, please refer to our monthly fact. 2024 will be a year where investors need to pay particular attention to political developments. And this month, I'm going to focus on that political risk. Political risk, insofar as it affects investors, is the risk of government repudiating its own liabilities to private capital, expropriating private assets, whether through taxation or control, changing regulations, trading practices, or laws which affect the profits of those assets, or restricting the flow of capital to equity investors through capital controls or taxation. Now, in a free market economy, government stands back and it lets people, through good ideas, good management, access to capital, and ease of doing business, invest capital, create jobs and profits. That is the only way in the history of mankind that wealth has been created. The best performing economies, like Singapore and Switzerland, have low taxes, robust property rights, high levels of human capital, and financially prudent, incorruptible government. A country with high political risk will generally have lower economic growth, since over time, investors will become more cautious about putting their capital at risk, and they'll demand higher rates of return to compensate them for that extra risk. Typically, it's only when countries are badly governed that politics becomes an important consideration in investing. Conversely, businesses need not influence or seek to influence good governments, whilst bad governments are constantly lobbied for their patronage. Now, for most of the last 40 years, political risk has been more prevalent in emerging rather than developed markets. But we forget that from World War II to the 1980s, there were capital controls in the UK, confiscatory tax levels, and regular government instructions to financial institutions in terms of what they should invest in. This is a risk again. Unfortunately, it seems like we are all emerging investors now. Last month was notable for its political developments, with volatility from election results in Mexico and India. And after month end, we also saw parliamentary election results that significantly weakened President Macron in France and Chancellor Scholz in Germany. The success in European elections for parties termed populist or far right by the sneering classes, but who articulate the growing frustration of culturally Marxist ideologies, whether that be wokeism, climate change alarmism, or immigrationism, all of these perceived to undermine standards of living and national identity. Just like most investors failed to understand or empathize with the rational appeal of Brexit in 2016, there is a risk that this political backlash within the EU is underestimated by the market and by professional investors in general. It seems that by calling early parliamentary elections, President Macron may also be underestimating the seriousness of the situation, as David Cameron did in 2016. It is quite possible that we are seeing the beginning of the end for both net zero and the EU. In America, former President Trump was convicted of the felony of misclassifying a legal expense for his own business records, based on the testimony of a convicted perjurer, on the assumption that the motive was solely to influence the 2016 election, and based on the supposition that the chosen venue of prosecution, a state court in Manhattan, where jurors selected from an overwhelmingly anti-Trump electorate, had the authority to rule on charges related to a federal election. Now, many investors have a visceral dislike of Donald Trump and are overlooking the risks to the democratic process of a blatantly politically motivated prosecution on frivolous charges of the leading opposition presidential candidate a few months before the election. The risks of this should be obvious, as is the risk of retaliatory abuses of the legal system. The founding fathers would be turning in their graves. Had this abuse been perpetrated in Russia or under a similar tyrannical regime, traditional media outlets would have been outraged, whilst investors would apply an appropriate discount rate to domestically domiciled financial assets. This abuse of judicial authority is not bullish for the sanctity of American property and political rights. It is intended to humiliate Donald Trump, but it ends up undermining American soft power and the global hegemony of the dollar. Ironically, the UK election day is on July the 4th, American Independence Day, whilst the US election is on November the 5th, which since the Elizabethan gunpowder plot has been the most politically celebrated day in the English calendar year. Every child in England is taught to remember the 5th of November. Investors should prepare for political fireworks. Gold seems the most attractive hedge to us, and we are articulating this through gold mining equities. UK Prime Minister Sunak called an early general election, which it is almost certain that the opposition Labour Party will win. Insofar as the change of government is likely to affect the UK economy and the stock market, we are going to examine how the Labour Party differs in terms of ideology, policy, and the extent to which ideology and policy matter compared to other exogenous factors, which may or may not be more important. The Labour Party has said it is committed to economic growth. Who wouldn't be? Even wealth creation, but perhaps wisely, has been playing its ideological cards close to its chest on its economic plans. We can instead look to the Resolution Foundation, a left-wing think tank to which Shadow Chancellor Rachel Reeves seems to almost exclusively defer to her policy ideas, which recently published an extensive policy paper entitled Ending Stagnation, which largely lays the blame for Britain's anemic economic performance on inequality, a word which is repeated 186 times in the 291-page document. Perhaps unsurprisingly, they look to government to fix this inequality, specifically the new Labour government. But government spending has already risen from 600 billion in 2001 to over 1.1 billion during COVID, where it has, perhaps surprisingly, remained. Never once did the Resolution Foundation consider that too much government, rather than too little, was responsible for Britain's economic problems. Let us remind ourselves that over the last 15 years, owing to permanently high fiscal deficits, government debt as a proportion of GDP has risen from 40 to 100%. To put this into perspective, government spending has gone from just 1/3 of the economy to almost 1/2. This means that the private sector has gone from being twice the size of the public sector to almost the same size. This is important for two reasons. First, since taxes on the private sector pay for the public sector, at some stage the private sector will collapse under the fiscal burden of funding government. Second, to have more economic growth, we must have productivity growth. The public sector is not required to be productive, since it will always receive funding, even if it wastes resources. Only the private sector is forced to be productive through profit discipline, otherwise it goes bust, it doesn't survive. So I would suggest that any revival in the UK economy is dependent on the private sector expanding faster than the public sector. Now let's now also look at inequality. In 2008, GDP per capita in the UK and the US was roughly similar. But since then, UK GDP per capita has stagnated at $46,000 or £36,000, whilst in the US it has grown 60% to $76,000 or £59,000. So Americans, including poor Americans, are on average 65% richer than their UK cousins. Most sensible people would want to know what the United States was doing and have some of that for Britain. Instead, we are told by the Resolution Foundation, success for Britain does not look like becoming America. Despite being far richer, the past decade in the US has shown the dangers to democracy from being the most unequal advanced economy in the world. We are instead told we should follow European economic models, which not only have been less successful than America, but which have suffered a similar stagnation in standards of living and GDP per capita to the UK. Instead of copying success in America, we are told we must be more like Europe, where they may be poorer, but at least they are more equally miserable. It seems obvious to me that equality of outcome and wealth creation are incompatible. As Charlie Munger was fond of saying, show me the incentives and I'll show you the outcome. Under 11 years of Margaret Thatcher's government, UK GDP per capita rose by 143%, from $7.8 thousand to $19,000. Let's remind ourselves of her last performance in the House of Commons in 1990.
7 years, the gap between the richest 10% and the poorest 10% in this country has widened substantially.
That's right.
How can she say at the end of her chapter of British politics that she can justify many people in a constituency such as mine being relatively much poorer, much less well housed, and much less well provided than it was in 1979? Surely she accepts that is not a record that she or any Prime Minister can be proud of.
Mr. Speaker, all levels of income are better off than they were in 1979. But what the honourable member is saying is that he would rather the poor were poorer, provided the rich were less rich. That way you will never create the wealth for better social services as we have. And what a policy! Yes, he would rather have the poor poorer, provided the rich were less rich. That is a liberal policy. Yes, it came out, he didn't intend it to, but he did. I give way to the honourable gentleman.
I'm extremely grateful. The Prime Minister is aware that I detest every single one of her domestic policies and I've never had that.
And I think that the honourable gentleman knows that I have the same contempt for his socialist policies as the people of East Europe who have experienced it have it on that. I think I must have hit the right nail on the head when I pointed out that the logic of those policies are they'd rather have the poor poorer. Once they start to talk about the gap, they'd rather the gap was that. Down here. That. Not that. But that. So long as the gap is smaller, so long as the gap is smaller, they'd rather have the poor poorer. You do not create wealth and opportunity that way. You do not create a property-owning democracy that way.
Wasn't she wonderful? There is considerable conjecture that a new Labour government intends to unveil a programme of tax increases on various sources of wealth. But insofar as Labour has been willing to set out its economic agenda, the main points of consideration for investors in British assets are excluding strategic investments from day-to-day fiscal deficits and government debt calculations, presumably so that reckless fiscal spending can appear prudent and debt can be hidden off balance sheet. Forcible consolidation of defined contribution pension funds. These are expected to grow to over £1 trillion by the end of the decade, so that these pension funds are more active, take more risk, and are willing to direct company management and invest more in the UK through public and private equities. Now, there's a strong suspicion that these pension fund assets would be coerced into supporting Labour's industrial policy, accountable to government ministers rather than their underlying investors. In April, the Financial Times reported that £3,000 tickets for the Labour Party conference business day had seen a Glastonbury-style rush. I would suggest that they were not there to keep the red flag flying, but to lobby for taxpayer subsidies to support otherwise unsustainable business models. Labour will also increase employee rights to make workers more secure and empower them to take more risks. What this means for health and safety, we don't know, but Labour believes that securonomics will have economic benefits without any explanation of how this has a positive economic impact, since this must necessarily transfer risk to business owners and entrepreneurs without any consideration of how this might impact their propensity to invest capital. And finally, Labour believes that the UK can achieve 100% renewable energy generation by 2030. According to Shadow Energy Minister Ed Miliband, who now has the look of a man who has just found his true calling in an apocalyptic cult, net zero is an opportunity rather than a cost. Regular readers of Argonaut blogs will understand that net zero by 2030 would not only be economically crippling, but would also be impossible without returning to medieval standards of living. On the morning of the 1987 election, which Labour leader Neil Kinnock was hopeful of winning, the Sun newspaper ran a front page suggesting that if Kinnock wins today, will the last person to leave Britain please turn out the lights? By the time of the next election in 2029, the last person need not bother with the light switches. Unless it is a particularly windy day, Britain will not have any electricity. Following university, Shadow Chancellor Reeves spent 6 years on the Bank of England graduate programme, followed by a couple of years working for Halifax Bank of Scotland before it was rescued in 2008 in the financial crisis from insolvency by Lloyds. In her opinion, this 8 years of real-world experience qualifies her to run the world's 5th biggest economy.
I spent my career at the Bank of England and in business before entering politics. I know what it takes to run a successful economy.
Since neither the BOE nor HBOS saw the financial crisis coming, and no one runs a capitalist economy, a less charitable observer might think this claim is like a surviving junior officer aboard the Titanic subsequently claiming that they know how to run the global shipping industry. And through their cumulative wisdom, they predicted World War II, the future invention of container shipping, the oil tanker, as well as competition from transcontinental air travel. Despite their anti-capitalist agenda, which must logically also be anti-growth and anti-profit, Labour could yet get lucky and found that their inheritance, which is clearly inferior to that bequeathed by the Conservatives to Tony Blair in 1997, turns out to be less bad than commonly thought, and that Labour get credit for an economy that performs better than expected. With his old graduate trainee in residence at number 11, Bank of England Governor Andrew Bailey might suddenly find some enthusiasm for rate cuts. Although only 1.5 quarter-point cuts are currently priced in this year starting in November, inflation should soon fall back to below 2%, meaning that we might soon have base rates of 3 rather than 5%. This makes Sunak's decision not to hang on another 6 months and to call an early general election even more baffling. UK capital would be wise to remain sceptical of any honeymoon period. The new Labour government will seek to roll back capitalism through anti-supply side reforms. These might well empower workers, reduce indigenous man-made CO2 emissions, and reduce inequality, but they are incompatible with economic growth, and they will make Britain poorer and the UK stock market even more reliant on overseas profits. And by the time we get to the next general election in 2029, we may need not worry about turning off the lights.